Hey guys, continuing this series on smart money moves for pre-retirees. As always, this is not personal, financial, tax, or investment advice. It's just for education only. So today's topic, tax bracket management, what you need to know with a particular eye to Medicare planning. So what do I mean when I say tax bracket management? When you're in your working years, you're going to get income from your employer, whether that's W-2 or whether you own a business. You have very little play into what tax bracket you're going to be in. Meaning, if you're a W-2 employee, you might be able to contribute to a 401k to lower your taxable income, etc. But your tax bracket is going to be very much more or less, it's not going to be that flexible. When you get into retirement, you have the ability to almost create what tax bracket you want to be in what year, according to your needs. What do I mean by that? So if you have a Roth IRA, if you have a brokerage account, if you have tax deferred accounts either through a traditional IRA or a 401k, if you have annuities, all of these things are going to play together of how you distribute your income in retirement, which means you have a little bit more flexibility. So I meet with clients all the time, and oftentimes retirees ask me, Forrest, what can I do to mitigate my taxes? And a lot of times I just have to deliver the bad news to them that they are not diversified enough and there's not really a lot that I can do for them. Now, that's why this is a smart money move for a pre-retiree. So why did I mention Medicare planning at the beginning of this video? So there's something called IRMAA, which is an income-related monthly Medicare adjustment. And basically what IRMAA is when you turn 65, they are going to look back 2 years to see what your income was. And if your modified adjusted gross income is above a certain amount, you will actually pay more for your Medicare premiums than if it were lower in those years. So the moral of the story here is that takes some advanced planning, at least 2 years in advance. So hopefully what you're getting from this video is understanding that when you get to retirement age, the reason you diversified throughout your working career in your investment accounts is so that you have more flexibility on how to manage your tax brackets and how to make sure that your taxable income can change according to your needs. Only one example in this video would be Medicare planning, but there are many others. Hope it's helpful. I'll see you next time.